Today, we will talk about Chapter 17, Capital Structure, Limits to the Use of Debt. We will go over agency cost of financial distress, agency cost of equity. We will talk about modern capital structure theory, trade-off, and pecking order theory. Lastly, we will go over capital structure choice in practice. Debt tend to have a negative image. People are afraid of too much debt may cause company go bankruptcy. While bankruptcy cost is expensive, it is the possibility of going bankruptcy will reduce firm value. So the possibility is called bankruptcy risk. Direct bankruptcy costs involve legal and administrative costs. These are expensive. In the case of Enron's bankruptcy in 2005, it cost about $1 billion, which is about 3% of firm's value. But the possibility of going bankruptcy could bring negative image to the firms. Potential buyers or investors more stay away from the company's product or service in fear of the service and the parts replacement in the future. So these are indirect bankruptcy costs. So the reduced sale could cost firm as much as 10 to 20% of firm value. The direct bankruptcy costs and indirect bankruptcy costs, altogether we give it a name called financial distress costs. When company has too much debt, one possibility is they might have very chance of going to bankruptcy. So I'm going to talk to you about agency cost with too much debt. So shareholders or managers, when they are afraid of not getting much money left after paying off their debt, they may engage in something we call selfish strategies. So these selfish strategies will benefit the shareholders at the cost of the lenders. So these are selfish strategies we call agency cost because they are not best for the firms as overall. So selfish strategy could be incentive of taking larger risk investment or past good investment, underinvestment, or milking the properties. Let me give you examples. Why the shareholders would like to take a larger risk. So the company could invest in a low-risk project. So tomorrow there's a 50% chance economy may go to recession or boom. So during recession, firm investment bring in $100. After pay off 100 debt, shareholder left with nothing. During boom, shareholder left 100 after paying off $100 debt. Now let's look at on average. What's the value of firm? Value of firm on average is 150. The value of the stock is $50. So let's compare another opportunity, which is high risk investment. When we say high risk, means this is going to bring in much more money during boom, but it's going to bring much less money during recession. So it's much wider spread. So let's take a look again. So during recession, the investment only bring 50, so that's all the lender is going to receive. The company have to claim bankruptcy in this case. During boom, shareholders will have $140 left after paying off $100 debt. Now let's look at the firm values in this case. 50-50 chance, the firm's value on average is 145. Are we better off or worse off? Compared to a low-risk investment, firm value is 150. So investing in high-risk investment is not good for a firm compared to a low-risk investment. Let's look at shareholders' value. On average, Shareholders doing better increased from 50 on average to 70. So this gives incentive to shareholders to engage in larger risk investment because they are better off in the boom economy, and in the recession they don't get much anyway. Let's see another example. It's called incentives toward underinvestment. So again, we have the same background. The company is loaded with lots of debt, too much debt. Okay. So without any investment, company will bring in 5,000 in boom. After pay off 4,000 debt, shareholder left with 1,000. During recession, company only make 2,400, so they go bankruptcy. Lenders get off 2,400. Now there's a good investment that comes along. It cost initially $1,000. So this is going to bring in 1,700 next year at 30% discount rate. So the net present value of the investment is positive $307. So this is a good investment. Would the shareholders be interested to take this investment? Let's see the numbers. With the investment, this will increase our cash flow by additional 1,700. So during boom, shareholders receive total 2,700. During recession, the cash flow also increased by 1,700 to 4,100. After paying off 4,000 debt, shareholders left with $100. So let's look at the shareholders payoff. 50% left with 2,700, 50% left with 100. It is the shareholder who have to fund initial investment for this project. So as a result, the shareholders' average value is $400, which is actually worse than 500 when they don't invest. So why is this case? As you see, the improvement in the cash flow during recession, the most of the cash flow improvement goes to the lenders. Shareholder does not benefit as much. It is the shareholder who have to fund the initial investment. You may be wondering, why don't the lenders fund this investment? If the lenders give you another loan of 1,000, it's become another loan. Could be a junior loan, right? Does not really reduce the initial amount of $4,000. So as a result, in this case, shareholder has incentives to pass the good investment, stay with the one without, than under investment. Sometimes shareholders, managers may sell assets, give out a liquidating dividend to shareholders when they see their bankruptcy possibility is real, close, and high. They may also increase the bequests to shareholders or management. So as you see, when company has too much debt, managers may engage in these selfish strategies, which are not necessarily optimal to firm value and benefit shareholders' interests, but at the expense of the lender's interests. What the lender can do to alleviate such agency cost with too much debt? One of the recommendations is lenders could put protective covenants in the debt contracts, such as the asset disposition restrictions, financial statement restrictions, okay, future borrowing restrictions. Another solution is to reduce the number of the lenders. In case of the possibility of a restructuring, then negotiating with fewer lenders is easier to reach an agreement. Below I have an example for you to practice. I want you to figure it out. The company was a low risk and high risk project. What's the value of the firm, a shareholder's value under the two scenarios? I'm now going to introduce the first modern capital structure theory. It is called a trade-off theory. Trade-off theory said company will choose a debt amount by balance the marginal cost of the debt and the marginal benefit of the debt. As you see, firm will increase debt with the benefit of the debt borrowing. Then later on, they will reach the maximum amount as more debt will lead to a more financial distress cost. As you see, each company will result in an optimal amount of debt. In other words, they may have a target, the best debt-equity ratio for each company. Over the time, company will rebalance, come back toward target debt-equity ratio if they are away from this number. So that's a trade-off theory. The amount of debt or change of debt will signal firms' values. Think about that. What kind of firms would like to take more debt? If company with low anticipated profits, they struggle a lot. They may not be able to produce profit. Will they be comfortable or confident to bring in more debt? Typically, it is the company who has confidence, who are doing well, who has expected high profit. These companies are more likely to take on more debt to maximize or take advantage of a tax shield of the debt borrowing. From this line of logic, when investors observe a company announce debt increase or increase leverage, on average, the market reaction is positive. Why? Because rational investors interpret this as a positive sign, means the firm value could be high and the firms are doing well with solid profit. It is very costly if the manager want to fool the market, put on debt which is beyond their optimal level, because there's a real chance of going bankruptcy. I'm going to introduce you another concept which is called agency cost of equity. So managers are typically hired by the owners. So managers are not necessarily the owner, especially for the large corporations. On average, managers own less than 5% of the company. That means for every $1 they wasted, only cost them 5 cents. Of course, the company must have lots of money to begin with if the manager wants to engage in wasteful activities. So free cash flow is the case. Company has too much money left. They tried, exhausted all good investment opportunities. Okay? So if they want to continue invest, they may have to consider the opportunities which are not very good or may actually lose money. So in order to reduce the chance the managers waste those free cash flows or engage in bad investment, acquisition, or project, there's some recommendations we want to reduce the free cash flow issues. One is try to reduce the amount of money left. Okay? The managers can give out more cash dividend to shareholders. So reduce amount of the free cash flow left. Investors, they receive cash dividend. They can invest by themselves. The second recommendation is to increase more debt amount. That will reduce the amount of cash flow left in the company. That also usually provide a good incentive for managers to work harder. Now I'm going to introduce you one examples. So how the debt motivate manager or owners work harder. Mr. Carlock owns his own company, and the company was $1 million. Now he wants to grow the company's size. He needs to raise additional $2 million to expand. He has two choices. To go with that borrow $2 million at 12% interest rate. Or he can sell more debt. In this case, he's not going to buy additional more stocks, so his ownership will be diluted to one-third only, 33%. There's two work schedule. If he work 6 hours a day, he produces 300,000 cash flow. If he work harder, 10 hours a day, he will bring in 400,000 cash flow. We want to see different finance, how the different finance affect the manager's incentive to work harder. The top table is debt borrowing case. So after pay off the interest payment, 12% of $2 million, Mr. Kellogg will be left with $60,000 if he works 6 hours a day. He will have $160,000 if he chooses to work 10 hours a day. Now, if you go with equity financing, remember Mr. Kellogg ownership is reduced to one-third, so there's no interest payment. Okay, one-third of total cash flow. So in case he chooses to work 6 hours, he has $100,000. If he chooses to work 10 hours, his cash flow goes up to 130,000. So compare the cash flow under debt issuing and equity issuing. Compare the work schedule of 6 hours, 10 hours. You notice there's a huge jump if you work harder under debt borrowing. The increasement is not that significant or big under the equity issuing. So as you see, the debt gives a much more incentive to motivate managers or owners to work harder. There's another example for you to practice free cash flow. I want you to calculate under debt or equity financing choices. Which one would motivate Ms. Trump to work harder? The second modern capital structure theory I'm going to introduce today is pecking order theory. The main logic behind pecking order theory is asymmetric information. So let me first explain how the asymmetric information comes to effect. So manager is the one knows everything about the company. Shareholders are less informed, so they have an information disadvantage. So when the firm announces they sell stocks or bonds, the shareholder or investors they tend to discount because they don't believe the amount of offered by the company. So another example we may often heard of is a sell used car. Suppose you own a used car you want to sell, you ask for $6,000. So potential buyers come along, they are less informed. They don't normally take the 6,000. They believe if you ask for 6,000, this used car typically worth less than 6,000. So they tend to discount, maybe offer you 5,000 or a different number. So same thing applies when the company sells securities, stock or bond. When companies sell stock, when they ask for $50, the investors, due to they are less information informed, they tend to discount and are willing to pay less. Due to these reasons, according to pecking order theory, firms should first use internal reserved money, internal fund. Then if they want to raise money externally, they may want to start with debt first and equity last. The reason equity last because equity financing is the one has huge asymmetric information effect and tend to discount a lot. So the pecking order theory implication is there's not necessarily a target to equity ratio. The firms who keep the internal retained earning has the value. Rich companies has a lot of money saved, so they not necessarily borrow. go out to borrow as often. The third modern capital structure theory is called market timing theory. Market timing theory was proposed by Berger and Workley in 2002. Those are pioneer behavior financial economists. Their theory proposed that firms should choose to use equity or debt based on the degree of mispricing or overpricing by the financial markets. One example is at the late of 90s, there's a lot of e-commerce and the stock bubbles. Everybody is thinking this e-commerce stock worth a lot more money. So investors are willing to pay for a lot for this stock. So in that case, according to market timing, you may want to take advantage of this overpricing and issue stock and raise money. So now we have introduced the three capital structure theory. One is the trade-off, second the pecking order, the third one is market timing. What are the other possible factors affect our capital structure theory or leverage ratio? How about a company who has growth potential? Company is young, just started, they don't have much money. They have to constantly go out to raise money, but they do have a huge growth potential. For this type of company, equity is better because investors are willing to pay a lot for their growth potentials. So they can easily raise money by selling stock. However, that not necessarily is a good idea because they need to raise money constantly, so strong debt commitment may put them jeopardy and risk. Depends on how much money the shareholders or lenders receive after the tax payment, so they may also affect the equity ratio. So now let's put everything together, take a look at how companies establish capital structure choice in practice. So what we observe is number one, we don't see company loaded with a lot of debt. So on average, the leverage tend to be low. Number two, we observe signaling effect. When company announce increase or decrease the leverage, increase or decrease the amount of debt, they bring the positive or negative signaling effect. We observe there's variations across industry and sectors. Certain industries tend to have a higher leverage, others may have low leverage. We found evidence to support the trade-off theory, and we noticed firms seem to behave as if there is a target debt ratio. They tend to bounce back if they are away from this range. Tax could affect the equity ratios. The type of tangible or intangible assets may also affect the debt equity ratios. If company has a lot of uncertainty in their earnings, so company with high volatile earnings may want to have a lower leverage. We also observe evidence that support the pecking order theory. Firms like to save internal funds, want to save retained earnings inside. Firms prefer to issue debt before they consider equity financing. So this chapter mainly went over agency cost of financial distress, agency cost of equity free cash flow, modern capital structure theory trade-off, pecking order market timing, and capital structure choice in practice. So that's all for this chapter.